Okay, so we'll be looking at the statement of financial position. So the same splitting we did to income statement, statement of profit or loss, is the same that we want to do to statement of financial position for Nestle PLC. Okay, so looking at the line item in the balance sheet, which is the statement of financial position, property, plant, and equipment needs no splitting. Uh, but if we can get the historical cost, so in the statement of financial position, what we actually need is the net book value. So this is okay for us to have. No need of splitting it between cost, original cost, and the accumulated depreciation. Then we have right of use assets. So right of use assets is an is a byproduct of lease. Is a byproduct of lease, which in this case would be a finance lease, um, as a result of IFRS 16. So this will also be depreciated based on the life of the lease, and no need of having any split in this line item as well. Then we have long-term receivables. So long-term receivables, and we've got receivables here as well. So the um, the auditors of these financials have actually separated the receivable based on the time that it will take for that amount to be recovered. So as analysts, we need to merge this together. We need to merge this together. Although there are times that you could still have them separated, but you need to know the composition of what makes up the long-term receivables and and the trade receivables. So if there's a trade receivable in the long-term receivables, then you then need to merge them together and give it a line item. So this is one item that we need to look into it, which is note 16, and see the composition as well as the trade and other receivables. We need to look at it and get the composition. Okay, so then we have inventories. Yes, inventories, there is no need for splitting the inventory line. Then right of return assets. So right of return assets is as a result of IFRS 15, which which stipulates that when goods are sold and they have possibility of being returned, or a clause in the contract states that the product can be returned either in any given number in any given time period, then that amount that is sold will be the cost of that item that is sold will be separated from the inventories and taken as right of returned assets, meaning that uh, on a good day, this when goods are sold, the inventories will be credited and the cost of sales will be debited. But in this case, inventories will be credited, but cost of sales will not be debited, but the right of return asset will be debited to show that that item can possibly be returned. So it will only be reversed and taken to it will only be taken to cost of sales when the stipulated time for return has elapsed, and the company can no longer take return of that particular product. So that also um, it's synonymous. It's actually inventories. It's inventories at cost that is actually in here. So we can treat it the same way we treat the inventories here. Then trade and other receivable, I've talked about that, needs splitting. For trade, we need to split trade receivable so that we could know the number of days that receivables are actually uh, uh, staying without being recovered. Then we have prepayment. So prepayment, there's no need for splitting here, no need of splitting. Then cash and cash equivalent, no need of splitting. Then we go to the equity side, issued capital, no need of splitting. Share premium, no need. Share-based payment reserve, we talked about that in the income statement the other time. So this is the other leg for the share-based payment that is part of equity. So IFRS 2 actually back this up, that shares that are issued to employees or suppliers should be separated for shares that are fully paid, fully issued and paid for. So that is why this line item is actually coming as a different line item aside the issue share capital. All right, then we have retained earnings. So these are clear line items in the statement of financial position. Then we have loans and borrowings. So loans and borrowings, you've seen it here. And if you go to the current liability side, you also see loans and borrowings. So this, as an analyst, you need to merge these two loans together, because the auditors here have actually separated them on the basis of timing, time, how long it will take for that loan to be due for collection. So that's so for as an analyst, you need to merge these two line item together into one, then look into the composition of the loans and borrowings, and be able to model each of the loan types that is included in it. Then employee benefits here, so no need of this, no need of splitting this. We know it is remunerating the staff of the company. Then we have lease liabilities. So lease liabilities, we have return use of right of use asset up there. So this is the liability effect of that right of right of use asset, which I said is a result of IFRS 16. So this is the other side of it, where the amount to be paid as installment on the lease is actually reducing the total sum on the lease. All right. Then we have the VAT tax. So this is a clear line item. Then trade and other payables needs to be separated into trade payables and other payables. Different lines needs to be given to them. So this needs to be splitted. Then we have contract liabilities, we have refund liabilities, and so refund liabilities is a composition. It's also a component of IFRS 15, which we talked about here under the right of returned assets. So if you have separated the inventory that was sold and termed it return of right of returned assets, then if cash has been collected on that sales, that amount is also posted and termed as refund liabilities, meaning that the company is liable to refund the, the, the buyer of the company's product on the basis of that. Okay, then we have bank overdrafts, we have um, current tax liabilities, we have lease liabilities, we talked about that the other time. Then we talked about, and also loans and borrowing. Then we have provision. So these are clear terms. So where we need to work on is on the long-term receivables, trade and other receivables, um, trade and other payables. We also need to work on, on that trade and other payables here. And we need to merge the loans and borrowings together. So let's go into the Excel sheet and see what we've done. Okay, so this is the new sheet we created for um, statement of financial position. So I'm going to link this to our menu sheet, um, statement of financial position. So I then need to migrate to move the imported balance sheet item into that sheet. So I'm going to copy all. Let's see how I'm going to do that. So I light forward, and maybe I need to copy it with the dates, with the years. So I'm copying everything. I want to get to the last, to the end. So Control C, and I want to come to SFP here and probably start from 9, and I'll paste. So when I paste, so that it can copy the formulas that we have done on the subtotals. Alright, so I then need to readjust, to realign this for 2021. So I'm going to move it to 2021 because there is formula underneath. I just need to move it. 2020 is here. I just hope so. 2020, am I sure 2020 is there? Okay, it's there. So 2020, I'm going to highlight everything there. Yes. Then I'll drag the edge into its space. Then I need to move out these two. So I need to move out these two, then bring them back again. Yep. 2019 needs to follow suit. Okay. Okay. So this is not aligning me. So probably what I'm going to do is to cut. So cut, and I'll come here and paste. Then 2018, Control Shift down, Control X, Control V. 2017, Control Shift down, Control Shift down, Control X, and come here, Control V. Okay, so we have aligned them. Then these are notes to the account, which we may delete afterwards. So I'm going to press Control space bar, Control space bar, Control Shift. Let me use Shift forward, then Alt HOI to auto fit the column. So this is what I've got. So I don't need the years, since the years are aligned now. So I do not need this. Control Shift delete. Okay. So this is cell style row letter 1. So that is done. I can see that the total non-current assets F2 has been done for us. Control Shift forward, Control R, right. Then current asset F2, this has also been done. Control R. This total asset is current asset and non-current asset. So that is clear. Also F2, equity has been totaled. Control R. And the non-current liability, total non-current liability F2, this has also been done. Then we have the current liabilities itself, total of those, Control R. Total liabilities becomes non-current liabilities plus the current liability, control shift forward, and total equity and liabilities becomes total liability and equity. So we got that, control R. Alright, so we have a check here. So remember we had a difference of 1 in our P&L. So, and we're also having a difference of 1 in here. So, which we need to get rid of before we go in. You can see there is no formula here, so copy this, Ctrl V. Yeah, there's a formula here. So the only place we will have 1 is here. Okay. So this is our balance sheet, but we need to give it a subtotal star at 6, subtotal, that's it. Then this, Control Shift forward at 6, use my downward arrow key, enter. Why this, Control Shift forward at 6, my down arrow key, I need total star for the total assets. So that's also done. Total equity, Control Shift forward at 6, subtotal star, and total non-current liability at 6, enter. I'm using my downward arrow key to actually move, Control Shift forward at 6, downward arrow key, enter. Total liability at 6, downward arrow key, enter. Total equity and liabilities at 6, total sales star. So that is the sales stars for our balance sheet. That's the sales star for the balance sheet. So we've got that. Let me extend this at 6. Yes, we need row letter 1. Okay. So like we said, we need to look into the composition of long-term receivables. So we've also got long-term prepayments, long-term prepayment here. So long-term prepayment occur in 2017 and 2018, which we need to merge together with this prepayment figure. So let's go look at long-term receivables. So I'm going to check the current 2021, Control F, long-term receivable. Long-term receivable, we need to read the notes to the account. So here we are. So long-term receivable represent long-term portion of loans granted to company's employees, an amount receivable from customers on the traded assets deployed, which are expected to be paid after 1 year from date of financial statement. So Nestle Nigeria PLC actually sells its goods through distributors. So distributors like the company selling their product through depots. So those depots are their distributors, and so they move their goods and assets to set up these depots, and they are expected to be the money are expected to be paid, or cash are expected to be paid on these goods and assets that is used to set up on those depots. So that is what has been termed as long-term receivable. So you can see now that it is a composition of long-term staff receivable and amount receivable from customers on account of trade assets deployed. So the customers in this case are the depots, are the distributors that the company sells their goods through. So for this, the long-term receivables can be left to stand alone, you know. But the worry really is the amount to these customers that is merged with the staff. So amount receivables from staff is merged with amount receivable from customers. So we might need to merge it with our receivable, uh, trade another receivable. Let's see where we can find that. Trade another receivable. I think it's down, 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 down. Trade another receivables. Okay, so trade another receivable. So you see the trade receivable is this figure. Then those things that make up other receivables are loans to key management personnel, staff loan, trade receivable due from related party, deposit with company registrar for dividends, allowance for expected credit loss. So these are the things that are actually embedded. So this is just like a bad debt. Deposit with company registrar for dividend. These are the stuff. Advance payment to suppliers, deposit for imports, other receivables. So these are the stuff that make up the other receivables. So what we need to do is to pick out the trade receivable out from those figures. So I'm going to press my Alt key and drag to copy 2021 trade receivables. Alt key, I need to copy these two figures. Alt key is not responding, so I just copy them one by one. So I go to my model and let me put the figure here, Ctrl V. That's for 2021. Then for 2020, I copy this. 2020 is this. So let me just put it in the front. So here I insert a new line and I copy this, I paste. So here I need to edit it to trade receivables, and I'll bring these two figures, Ctrl X, Ctrl X, Ctrl V. Alright, so given this, don't forget this is the former figure. So I need to separate these two into two things, trade F2 and other receivables. So I have other receivables. So I need to pick out the trade receivable elements out of that. So I go again and go to 2019. In 2019, I'm looking for receivables. I want the notes to the accounts, so I'm pressing enter as it continues to search. Maybe I would have added trade. Okay, so I've gotten there. So for 2019 is this. I'll copy that. Ctrl V. Then for 2018, I'll copy that. Ctrl C. Here Ctrl V. Then for 2017, trade receivables. So 2018 trade receivables is this. So I copied the 2017 trade receivable start. Control V. So we've got all our trade receivable now. Now we need to subtract what we've got in the total in the trade and other receivable. So this minus our trade. So it gives me that others are not non-trade. So Control C, Alt ESV, enter. So pasted that as value. So addition of these two is 31, 430, 450, which gives us this total. So now this can disappear from our analysis. So we have been able to split that now into two. Can you see? We're able to split that into two. So another thing that you can do is because I see that in the composition you will see that we also made some sales to our third party related parties. So trade receivables due from related parties, you know. So because transactions are to be treated as arm's length, so it is expected that the trade receivables will be split between those made to the customers who are external to the company and those that sales that are made to related parties. So that's the reason why this is also included. So we might want to also have this analyzed and see how long it's taking related party to actually pay us the trade. So you can split your balance sheet into that. Cut. And I want to have just a line item for that. So Ctrl D, trade receivables due from related parties. You might want to have this in your calculation, your working schedule, and bring the addition of these two as trade receivable into your balance sheet. So this will be due from customers. Due from customers. So you can see that there are two different things. So the amount due from the later party is actually embedded in these other receivables. So let's bring it out. 2021. So Ctrl C, Ctrl V. Then I go to 2020, Ctrl C, and I come here, Ctrl V. Now 2019, which is this, trade receivable due to related party, 2019. I copy that, and here I paste. Once more, 2018. I copy that, and here I paste. Y for 2017. I've got it here. Trade due to related party 2017 is this. So here I paste. So now, if I've pasted this, and I want to take the rest as other receivable, I'll then need to copy this and get my a new figure for other receivables. So this is used splitting the line item into key components that you as analysts actually want to those things that actually are key to the business operations of the company. So receivables, what the company sells, who they sell to, it's very important to actually saying something about the company's operations. So if the companies are sold to customers and it is this figure, and to related parties this figure, what is the proportion of sales that are yet to be received, the money cash is yet to be received on proportionately to those sales made to the to customers that cash has not been received. So this is key to the analysis you might want to perform as an analyst. So other receivables will then be this 17 minus this component. I will take it this R, and so control control shift forward arrow, control C or TSV, enter, and so that's been pasted as values, and this can be deleted. And so you see that your balance sheet is in balance as you make that adjustment. We had this one before now. Okay, so we have splitted our trade receivables into trade receivables due to customers and those due to related party, and we've got other receivables. So if you look at the component of other receivables, you might want to bring out any item here and actually uh, project it, particularly staff loan. So loan to key management personnel, staff loan, what other ones do we have? I guess that item might might be key to you, but looking at the figure for staff loan, you might uh, you might not want to pay a close look at what the impact of this figure is. But looking at the staff loan, this is huge, and might be something you want to take a look on and see how this loan reduced or increased over time, you know. And the other time we looked at long-term receivables, and we saw the fact that there is a composition that is related to a loan in the long-term receivables, long-term staff receivables, you know. So long-term receivable represent long-term portion of loans granted to company's employees. So these long-term receivables are those ones that are span 12 months. So they have termed it as long-term receivable, but they are loans that are granted to company's employees. So also we've got the ones stated under uh, the current asset here, which is in the trade and other receivables composition, termed as a staff loan. So you might want to add those two together and actually check the movement of this item in as it relates to the company's operations. All right. So, but then for you to uh, uh, actually put a key point on the staff loan, you want to know what rates is being charged on the staff loan, or whether there is no rate that is charged on the staff loan. So you might want to actually get this information in order to project this component of the other receivables. If you do not have, like here in this note to the accounts, I do not see anything relating to the interest charge. Included in other receivables are input taxes, infrastructure support to customers, advance to suppliers, is in respect of raw and packaging materials, while deposit for import is for items of plant and machineries, raw and packaging materials which are expected to be delivered before the end of the second quarter 2022. So no information really about the loans, the staff loan. So you might just want to leave it as part of other receivables. So I just hope that is clear regarding other receivables composition. So any item in the other receivables that you actually want to pay close attention to and see how it impacts the company's operations, you might want to bring it out of the other receivables and project it going forward. All right. So for now, I'm going to leave that as it is. So we'll move to prepayments. So in prepayment, we have a long-term prepayment and a short-term prepayment. So we need to merge these two together with this. So I'm just going to call it prepayment and put it under current. So I'm going to add the long-term prepayment plus the short-term prepayment, these two. And so you can see that this is the addition of long-term prepayments and the short-term prepayment that we're having here. So I'm going to copy that as value, Control C or TSV, enter, and I can get rid of the two values where they are. This is the second one. Get rid of this, Control minus. I highlighted and I press Control minus. Okay. So our balance sheet is still in balance. So when you make your adjustment, you need to ensure that you make your adjustment clearly, and that whatever adjustment you make, your balance sheet will still be in balance. So we've done that on the asset side. We've made the correction on prepayment. We also made the correction on trade and other receivables. So the next one will be for liabilities. So I see you in the next video.